Hello everyone and welcome to our yet another session on the computation of marginal cost of capital. In this session we are going to go through our exam type question, November 2017, Chap Chap Uganda Limited. The question has already been provided to you on the student account. I've also shared it on WhatsApp on the other groups. You can get it. So we are going to run through the question. In the first session of this discussion, we looked at the weighted average cost of capital. And of course, we mentioned in the lecture we had that the marginal cost of capital will arise if we procure more financing. If we procure more financing, then there's going to be a change in the weighted average cost of capital. So we read through the question in the previous session, and I'm focusing on note number 5 and note number 6. Those are the two areas that I'm going to focus on. That's the additional information I am focusing on in this session. Now, we are told that the company is to raise more funds of 1 billion, and this is meant to facilitate the expansion, of the company's operations. And the way they are going to raise this money is going to be through issue of new shares, and those are the ordinary shares, and also through issue of debentures. Now, as always, the examiner is going to tell you the proportion of the funds that are going to be raised. So good enough, here they have told us that the equity, which are the ordinary shares, represent 70. Basically, that would be 70% in terms of ratios. And then the debentures are going to be 30% of the composition of the new funds. So 30% of 1 billion, that is 300 million, and 70% of 1 billion is 700 million. Now, what you need to note here is the aspect of market values. It means that these funds are going to be raised in market value terms, in terms of their market value, that is to say. So it means that we don't need to convert into market values again, unless you want the book values, but here it's not going to be required. Now, as always, the ordinary share or the equity usually changes, especially when it comes to the price, the growth, and the dividend that's going to be paid. So those changes are going to lead to a change in the KE. So we shall need to compute a new cost of equity, which is the KE. Then the debentures are issued at a price of 90, and these are irredeemable. Remember, the debentures we had in the capital structure are redeemable after 10 years. So the ones you are going to obtain when you are raising the 1 billion are irredeemable. So it means that these are totally new debentures. So we cannot sum these on the old debentures. So we are going to treat this separately from the existing debentures. And again, this shows that they are new debentures indeed, because this is now 5%. The debentures we have in our capital structure are at a rate of 15%. They have a coupon of 15%. So it means that we are raising new debentures of 5%. So, of course, I've already indicated this in the discussion we had, but of course, the best way you're going to handle this is to approach this in a stepwise kind of approach. So, step number 1, you need to determine the new specific cost of capital because of the additional funds that have been raised. So, you need the new specific cost of capital. Typical is the cost of equity. The cost of equity is going to change because the DO has changed. The growth rate is still the same, but the price has also changed. So when you substitute in the place of DO, they have told us that the dividend comes to 250, so that's our 250 there. Then the growth rate has remained at 5%. Then the price, PO, has come to 2000. There's an increase in the price there. And then the growth rate will be added here on what you get, which is 5%. So at the end of the day, you come up with a cost of equity of 18.125. You come up with a cost of equity of 18.125. Please cross check and ensure that you have the same answer as mine. So when you're done with the cost of equity, which is the KE, we now move to the cost of the new debentures, which is the KD. Okay, we now move to the cost of the new debentures. And of course, we are told that the debentures are irredeemable. We shall not do the IRR like we did in the first session for marginal, for weighted average cost of capital. In this case, we are going to use KD is equal to I over PO. I is the interest, and the interest is computed on the coupon. The coupon rate is 5%, and the par value is 100. So the interest, we are going to get 5% times 100 divided by the price of 90 shillings. That's what we are told in the question, that the new debentures are coming with a coupon of 5%, and they are issued at 90, and that's the price. So we end up with a KD of 5.56. You can still verify this and see whether that is what you have. You can verify that and see whether that is what you have. So these are the two financial instruments that you need to work on. The rest are going to remain the same. We are only raising money through issue of ordinary shares and the debentures. Now step number 2, we determine the new market values for the new issues for equity and debt. So the equity, the market value of equity, the VE, you get the number of ordinary shares. That is the total, the original total capital structure, amount in the capital structure, which is 2 billion, divided by the nominal value of 1000 times the market value, the new market value, because they have told us that the price is going to rise from 1,500 to 2,000. So you multiply by that. Now, the trick that was here is on the new issue of ordinary shares. The new issue, amounts to 700 million. Now, this one you don't need to convert it because they have told us that this is in market value terms. It is in market value terms, so you don't need to convert it. So those who try to convert this, of course, you did not get the right answer. But try to take note of this, that the existing amount of ordinary shares are supposed to be valued to the new price of 2,000, and then if the new funds that we are raising are in market value terms, you don't need to convert them. So we come up with a value of equity of 4.7 billion. Now for the new debentures, the VD is 300 million. This is in market value terms, so we didn't need to do anything on this. We didn't need to divide and do all this here and there, what we are trying to do the other time. We don't do it because this is in market value terms. We only convert, maybe for those who are asking me that why do we convert this and then in some cases we don't convert. We only convert if we are moving from book values to market values. You all know that book values are historical in nature. Market values are current. So when your step number 2 is done, then you move to now step number 3. So in our step number 3, what we do, we determine the marginal cost of capital. Now for this, you don't need to compute the new work. You straight away calculate the marginal cost of capital. So as usual, This is our vertical format showing the source. We show the percentage cost, we show the market value, and then multiply the percentage cost and the market values in the last column. So these are the figures that I have. 18.125 times 4.7, that is 851. This one was the existing debentures. That's the figure we had. The new debentures, 5.56 times 300 million comes to 16.680. And then the existing preference shares, I bring them as they are. So at the end of the day, we compute our marginal cost of capital by summing up this and then subtracting the figure we initially had when we are calculating the weighted average cost of capital from the new figure. This one here, that's the figure that comes here. This is the figure that we have here. Then in the denominator, we subtract 4.2 billion, which we had when we are computing the weighted average cost of capital. And of course, this figure is subtracted from this 6.2 billion that we calculated when we acquired more funds. So you're going to look at this table, verify. Okay, you can even pause the video and verify with what you have, and also work through. So when you simplify the denominator and the numerator, these are the figures that I have, subject to your verification. Okay, my marginal cost of capital comes to 14.92. My marginal cost of capital comes to 14.92. All right, so that is what we have, and I thank you for your time. Please, if you have any comment, please, if you have any question, leave it in the comment section below. And also let me know that you have run through this lecture video by confirming in the comment section below. There's a comment section below this video. Please drop in your comment. I'll be able to get your reply, and if there's any query, I'll be in position to address it. So until then, I wish you all the best. I'm going to be sharing with you more questions, exam time questions, to help you improve on your skill of determining the weighted average cost of capital and the marginal cost of capital. What I need to emphasize that this area, please do not joke with it. As you can see, the marks that will you'll be able to gain if you handle it correctly are huge. There's a 15 mark here on the weighted average cost of capital, and also 6 marks on the marginal cost of capital.